The good news about India is it's not only institutions, right? There's also a huge role for family offices and HNIs to play. And I think that's where, we think we could be in the forefront of that. If you look at the global GPs, they're all doubling down on India, right? Whether it's venture capital, private equity, everybody is raising more dedicated capital for India. We have 85 portfolio companies at 361. 15 of them happen to be Soonicorns. And I think a large proportion of them are headquartered here in Bangalore. So again, great reason to be here. A lot of our founders are presenting today.
Hello, I'm Miloni Bhatt. From Wall Street to Mumbai, my guest has built a career spotting signals in the noise, backing founders, unlocking capital, and now shepherding $3.6 billion at 361 Asset. Sameer Nath, what a pleasure to have you here with us.
Pleasure to be here, Miloni.
You've gone from investment banking at Citi across 3 geographies and then co-founding Iron Pillar, True Scale, and now running $3.6 billion at 361 Asset from everything across early venture to pre-IPO. So that's quite the arc. When you look at where and when to place the bets, be it a newbie startup to a late stage deal, what is the playbook that you trust?
It's a great question, Miloni. I think, like you said, early stage venture is different from pre-IPO, but I think there's some common elements, right? And it starts with the people. I think for early stage venture, it is incredibly founder centric. So you're really looking for a first time founder to make sure there's that founder market fit, that they are going to be ready to execute and take it to that next level. Second time founders, obviously there's some more data points. I think when you get into the growth and let's say private equity, then it's about the team, right? And there obviously you have way more data points in terms of the business metrics. We'll talk about profitability, I'm sure, in this conversation. I want to mention that. And I think that's where it's the founder and the leadership team that we're backing. Because in all that we do, we're really backing the founders. We don't do buyout or control deals, right? So we're not going in there with our own teams. So we have to be aligned with their vision and then their ability to execute.
All right. Is it about stage or is it about signal?
So I think it's the way we have now constructed our platform. It's a really nice combination of stage specialization with industry domain expertise.
Okay.
And we always have that sort of, I would say, healthy tension, right? Where does this sort of really need a much more domain expertise? Where does it really need the hand-holding for the stage? How do we help them navigate the next phase of the growth journey? How can we add value? So I think that's how we sort of use our skill sets to partner with these partners.
All right, and we'll talk a little bit in detail as the conversation progresses. But I wanted to talk about exits. I think you've mentioned somewhere that about $200 billion of investor and employee money is stuck in Indian startups waiting for exits. Now, you've seen it play out globally, when you were a banker, right? And now you are at the center of India's version of it. So how does 361 help unlock that capital for those who want to sell without it feeling like a fire sale? And secondly, what's the strategy for finding out the fair prices when everyone wants to sell?
Absolutely. And I'm so glad we're having this conversation in 2025 when I actually have some good news. I know we're going to talk about IPOs later, so maybe I'll talk about the rest of the exit market. So look, I think one stat that is really heartening is in years past, let's say 5 years ago, investment volumes versus exit volumes, that was about a 5 or a 6x. Yeah. In 2024, it was only 2x. Yeah. So the exit volumes in India have really ramped up. They crossed 27 billion last year, and about 35 to 40% was non-IPOs. Oh, wow. Right? We'll talk about IPOs in a little bit, but so this is the point. So there is M&A. Yes, there are secondaries, but I think because they're new to India, secondaries are associated with distress or fire sale. That's not always the case. You can have very high quality companies. It's like horses for courses, right? If you look at the direct secondaries deals that we have done from India's first secondaries fund, it's very much about matching the investment horizon to that company, right? There are some terrific early investors who have been there 6, 7, 8 years.
Right.
They're approaching end of fund life.
Yes.
So they will get a good exit, maybe leave 10% for the incoming guy. So it's not. So I think that's the first clarification. There's a handful of multi-asset portfolio secondaries where I think the deeper discount may apply, but otherwise, it's actually a win-win for both seller and buyer.
So it's not panic mode, it's patient.
Not at all, not at all, not at all. And by the way, M&A is not just foreign investment. There's also domestic consolidation. Now you have startups and conglomerates, old industrial companies looking to this ecosystem for inorganic growth. So that will continue, even though most of it will be IPOs. I think this is very healthy for India, that there is other activity in addition to the capital markets.
All right, so let's talk about the IPOs. India's IPO market, as you know, has been buzzing.
Yeah.
And in 2024, we have some statistics that 29,000 crore was raised just by new age tech companies.
Yeah.
Now here we've seen both triumphs and we've seen the tumbles.
Yes.
So what makes a company truly IPO ready versus one which is just IPO eager? And related to that, my question is, how do you coach founders on telling their story, so that they just don't pop on day one, but are actually winners in capital markets and stay winners?
Yeah, no, that's exactly the right question that we should all be discussing. And I think I'll be very blunt here and say that the difference is the 21 cycle versus the current cycle. I think the 21 cycle is exactly some of the red flags you were highlighting. Opportunistic, momentum, timing, those things are very short term and the public market is not kind. And I think some of those IPOs were also probably not ready for prime time, for the public glare, quarter to quarter predictability of financials. The biggest question on those IPOs was profitability. And I think since late 23, 24 and into 25, profitability has come to the top of every single IPO, new age and traditional. And I think unless management teams sort that out, it's going to be a harsh reality check when they go for that listing. So I think that is fundamental. And here, Meloni, I'm not just talking about EBITDA, I'm talking about PAT, right? PAT without adjustments. That is ultimately what you're going to be benchmarked against. I think our new age founders have realized that. They're all working towards that. They're communicating that. And I think that's going to lead to much, much better outcomes going forward.
All right. You also shepherded companies, or at least one company through an IPO. You want to talk a little bit about that?
Yeah, actually, the Bluestone listing has been just an amazing experience for me to be part of that for almost a decade. And actually, I would say the comments I made a minute ago apply here, right? If you just think about, the conversation we're having, starting off with the tech focus, as Bluestone scaled, Gaurav realized that tech and product could only get him somewhere. It was strategic investments in design, in retail, in manufacturing, getting both profitability and growth, the entire pivot to offline and the omni-channel operating model. That is what has enabled the successful listing. And the last part, I think, once you get that real path going, will be the sort of probably the next value unlocking in that journey.
All right, not linked to Bluestone, but just if you had to pick, over-prepared or under-prepared, what would be the IPO killer?
Oh, definitely under-prepared. I think The public market investors are very sophisticated. I think they ask all the right questions. We're also talking about an IPO a day now, so
Yes.
so you better be prepared when you go into that roadshow meeting, because otherwise they'll move on to the next one. So yeah, that's what I would say.
Over-prepared is much better than
Yeah.
being underprepared. All right. Want to shift the focus now to India. You worked in New York, you worked in Singapore, you worked in Mumbai. So essentially, you've seen all of these places, all of these, ecosystems evolve, right? Right now, India is in a sense the darling of global capital, especially as China slows down a little bit and the US gets a bit choppy. But simply beyond being an attractive market, what would you say is missing from India to consistently create global category defining companies? Would you say, for instance, that you need sharper founder discipline? Or would you say that you need deeper capital markets? Or would you say that this is just all a function of time?
Yeah, so there's a few parts to your question. I think, let me take the first one. So I think it's absolutely true. I just come back from New York. The spotlight on India is very bright. Global LPs are rotating away from China. If you look at just the recent conferences that we've hosted here, you're just seeing a increase both in quality and quantity from international institutional investors.
Right.
That's point number one. If you look at the global GPs, they're all doubling down on India, right? Whether it's venture capital, private equity, everybody is raising more dedicated capital for India. In our own case, we've now just had a strategic collaboration with UBS. And certainly India is the center of that. On the one hand, you have the wealth management side, but equally on the asset management and private equity side, we're super excited about the synergies that we're going to explore in the coming months and years. But I'll now actually give you a slightly different perspective. If you ask me what needs to happen, I would say that we actually need more domestic capital. That segment of the market is still shallow today. And the analogy I would draw is the Indian public market. If we were sitting here 10 years ago, we'd still be talking about FIIs, now FPIs, right? And the entire headline at ET and everywhere else is FII flows.
Right.
Are there inflows or outflows,
Outflows.
right? Is there the Fed doing something? Is there geopolitics, macros? That has nothing to do with India. It has nothing to do with venture. It has nothing to do with fundamentals. And I think till we had these massive mutual funds and domestic institutional investors, we were beholden to those FII flows. Today, they are very, I wouldn't say irrelevant, less relevant to
Today.
IPOs, to pricing of public market deals. In the private market, we're only at 20%. And I think if we can bump that up, it'll really be, I would say, a force multiplier for the Indian market, because you'll get, through the cycle, patient capital that's fundamentals based. And I think that's what India needs. By the way, that's what really drove the China private equity market, is getting that RMB capital into that majority, where today it dwarfs US dollar capital. We may not get that high, but at least taking this 20% to 30, 40%, I think will really help.
Well, my question is that, we still do have money flowing in, but do we have the systems, or are we really building the systems to absorb it, would you say?
It's a great question. Actually, IVCA is doing a great job in this regard, and 361 is partnering with them on some of these initiatives. It'll take time, but we have to start, right? And I think the good news about India is it's not only institutions, right? There's also a huge role for family offices and HNIs to play. And I think that's where, we think we could be in the forefront of that.
All right. More power to you. And this is now my last question to you. This is about the Soonicorns Summit. You're not just the investor in the room. You're actually a very integral part of the Soonicorns Summit here at the Economic Times. What convinced you to back this gathering? And, if you're all here again next year, then what would you want to hear founders and investors say has changed in India's startup story?
Wow. So I think I'll answer that question by linking it to this conversation that we've just had. So first, we're delighted with this partnership. We have 85 portfolio companies at 361. 15 of them happen to be Soonicorns. And I think a large proportion of them are headquartered here in Bangalore. So again, great reason to be here. A lot of our founders are presenting today. What I also presented in my keynote is of the 122 unicorns, which is the next level that all of them hope to graduate to, only 20 are listed. And I think if we were here next year, I would want to see a much higher proportion of our most valuable startups go into the public market and make that sort of that next leap as they continue that growth. So I would say that would be my hope, and I think it will happen at a much faster pace than it has over the last few years.
All right, clear-eyed, grounded, and with one hand firmly towards the future. That's Sameer Nath for you, reminding us what smart capital looks like. And it's been a real pleasure to speak with you. Thank you very much for your thoughts and for your time.
Thank you, Miloni. It's been a pleasure.